Well, the S&P 500 finished lower for the second straight day. Of course, this is only the second day of May, so some people are wondering if this is the year when we sell in May and go away, like sometimes you've heard from a seasonality perspective in the past. So we're going to take a look at what sort of damage, if any, has been done to the markets and whether it affects our posture at this particular juncture. I then want to take a look at some IPO information. Beyond Meat did have an IPO here today, and some of you might have caught that. It was up over 100%, so there's definitely some animal spirits alive and well as we head ever closer to the Uber IPO that will be coming up soon. And then in our trade application example today, I wanted to focus on a sector that's been beat up in the last couple of months for a bearish trading opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 2nd, 2019. First of all, if you're new, welcome aboard. Remember to go to our YouTube channel and click subscribe while you're over there. Then go down to our description area and sign up for our email distribution list. We'd also encourage you to follow us on Twitter. In particular, this weekend, I'll be heading back to Woodstock for Capitalists for the 15th straight year. Very much looking forward to that and seeing about 40,000 value investors hanging out with Warren Buffett and Charlie Munger. So if you're interested in my experience over the weekend, follow me on Twitter. My handle is @BrandonVanZee. In fact, all of these tchotchkes you see on our shelves back behind me have largely been attained through those meetings over the years. So I'll be looking for some additional rubber ducks or whatever they're going to be selling us this year. We also have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. This is our 4-grid that we use to kind of determine whether we have a bullish or bearish posture using the market forecast technical indicator. Now remember, the market forecast technical indicator is an indicator like any other, just like a MACD or a stochastics or RSI or relative strength or a CCI. But the difference is the market forecast can only be found on TD Ameritrade type of products like this Thinkorswim platform that I'm showing you right now. So some of you have access to that. You should be able to pull that up. But the different color schemes that you see here are our customized codes that we use specifically for our premium subscribers at Market Scholars to help us more easily identify different conditions that may or may not exist. So when you do see a green background color like we do behind all of the most recent candles for all 4 of these charts here in front of us, it identifies the fact that we remain bullish with our posture according to the market forecast intermediate term line. So remember, the intermediate term line is that green line you see down below in the market forecast area. And as long as that green line is in the upper reversal zone, like it is with all of our different charts here today, then we continue to retain that bullish posture. Now, obviously, that does change as time goes on, and that's why you sometimes will see these charts go from green to pink, like we saw back here. So if there is a little bit more wear and tear on the markets, either tomorrow or early next week, it is entirely possible that some of these charts will then start shifting over to a more bearish type of a posture. But remember, even if that were to occur, we would first go to a weekly bearish posture. In other words, not strong but weak. And then if that green line were to continue to fall and eventually get down below the 50th percentile, then it would be kind of viewed as more of a strongly bearish posture. So that is not in the cards as of this moment in time, but be on the lookout for it in coming weeks if the market continues to be a little bit under stress like we've seen in the first 2 days of May. The other thing I wanted to point out is that when you're looking at all 4 of these charts, so you got the S&P 500 in the upper left, you got the Dow Jones in the upper right, you've got the NASDAQ Composite in the lower left, and the Russell 2000 in the lower right. Notice that all of those charts still have price trading above a rising 30-day moving average. Remember, those moving averages will change colors depending on different circumstances and conditions as well. So as an example, back here, you'll notice that that moving average was yellow because price was below the moving average. Once it got back up above the moving average, that moving average automatically turned green. And so at this point, we continue to have green moving average across the board in addition to the bullish posture. So while it hasn't been quite as smooth sailing here the last couple of days, largely the path of least resistance continues to be to the upside until we see substantial evidence to change our minds in that department. So that's how we'll go forward with those bullish postures. Let's go ahead and take a look at our next chart setup now, and this will be our 3 green arrows chart setup. And this is chart 4C for those of you that are following along at home. Now, in this particular chart setup, the background color will identify whether you have 3 green arrows, 3 red arrows, or a mix of green and red arrows. And right now, the background colors over the most recent candle on all 4 of our charts is just simply white or empty. And what that means is we have a mix of green and red arrows. And so, just to give you one example, the S&P 500 is in the upper left here. You'll notice the S&P 500 was down 0.21% today. The only index that was actually up today out of these 4 was the Russell 2000, which was up 0.4%. But anyway, up here with the S&P 500, you'll notice that it lost its green arrow on the MACD histogram just a couple of days ago. We've got this red arrow to contend with now, and that basically tells us we've got a little bit of a loss of momentum within that particular security, in this case the S&P 500. So if we get a bounce off this moving average back to the upside, there would be a decent chance that this arrow on the MACD would go back to a green arrow. But until then, as it stands right now, we've got 2 green arrows, which is on the moving average itself, and then a phantom green arrow down here on the stochastics, and we've got 1 red arrow here in the MACD histogram. In fact, the MACD histogram appears to be red arrows on all 4 of these charts right now. Now remember, if you enjoy trend trading, particularly with the 3 green arrows philosophy, you might enjoy my Monday top-down trend trading class. Now, of course, this upcoming Monday, I'm taking the day off as I'll still be back in Omaha, but in future Mondays, I would invite you to join me if you are a premium member of Market Scholars. One thing along those lines that I wanted to share with you, I've been collecting some data over the last couple of weeks and really crunching some numbers, and I finally was able to do a recording last night to kind of have a little conversation with those of you that attend that class. And I did just get done posting that here on our calendar. So again, if you are a premium Market Scholars subscriber, feel free to check out this recording here on the 6th of May, which of course hasn't happened yet, but that would take the place of normally I'd be having a live class there, like the next week after that I'll be teaching that class at 11 a.m. Eastern time. But since I'll be out of the office this upcoming Monday, at least gives you something to sink your teeth into, even though we won't have a live class. And I wanted to have a conversation about our risk management technique and a new technique that I've uncovered that appears to be better than the old technique that we were using to manage our risk in that particular account. And I've got lots and lots of evidence to support that and a spreadsheet for you to download and all that kind of fun stuff. So anyway, feel free to check that out. I thought I would mention it here since that was kind of a one-off type of a class, not one of our normal live trading rooms like we typically teach. Also, while I'm over here, quick reminder that I did teach my question and answer session earlier today, so feel free to watch that recording once it becomes available. And then David taught his portfolio management with ETFs class. And then tomorrow, David will be teaching his very popular technical analysis trading room as well. So lots of good stuff there for those of you that are premium Market Scholars subscribers. Also, appreciate all of you that click like and retweet on these market outlook related posts that we put out there. 90 of you did that for me last time around, and I appreciate that because I think that was more than the 76 that we had before that, but I still contend that we should be able to get, without too much difficulty, 100 of you saying that you appreciate these videos. It takes 5 seconds of your time, and it's absolutely free for you to do. And of course, David and I put in multiple hours in producing these videos. So I think you get the better end of the deal there. If you can give us a like in return for our continued work for you, we'd really appreciate that. Thank you so much. All right, back to the charts. Let's go ahead and take a look at our 1040 crossover method now. This is chart 4D. It's going to be the same 4 indices here that we've looked at before, but in this particular case, these charts are going to be 3 years in length. The other charts we've been looking at up until this point have been 3 months. So this gives us a longer term view of kind of how markets have come along here and throughout their journey of the last 3 years. And as you can see, the background colors of all 4 of the charts are green. And what that signifies on this particular chart setup, which is chart 4D, for those of you that are premium market scholars, what that signifies is we have bullish crossovers that have taken place from a moving average perspective. And the moving averages that we look at on this particular setup is the 10-week moving average versus the 40-week moving average. The most recent crossover that we experienced was in the Russell 2000 that occurred here at the beginning of April when we had that orange line that represents the 10-week moving average go up and through the blue line, which represents the 40-week moving average. The other indices had already crossed earlier in the year. So right now, from a longer-term perspective, our postures are still largely bullish, at least from this philosophy. Let's take a look at our next chart setup now. This is going to be chart 4E. These are our 12 grids. Now, a reminder on these 12 grids when we go through them, I did have a good question about these 12 grids in my Q&A session here today about how to change these from 12 into 4 and different things like that. Remember, you can come up here to your grid area above your charts, click on that, and then use some of these different features up here if you wanted to do that. So if I wanted to change that 12 grid into 4, I can just highlight over this 2x2 that I have up here, click on that, and then that does change that into just 4 charts there if you wanted to. Some of you, have bigger monitors, some of you have smaller monitors, so everybody's setup's a little bit different, but just wanted to highlight that since that was one of the questions I received earlier today for those of you that were in that particular class. All right, let me go back on over here now to this 12 grid view. And as a reminder, when we're looking at these charts, the background color will tell us whether the market forecast intermediate term posture is either bullish or bearish. If the background color is green, then that means that according to that market forecast, it has a bullish intermediate posture. If the background color is pink, then it means that that particular security has a bearish posture according to the market forecast intermediate line. So you'll notice that the bullish charts that we have on the board, in this case, the VIX, although I wouldn't necessarily identify that as a strongly trending security, but nonetheless, it has enough boost here in the last couple of days to have that posture be a bit bullish. Notice it is trading above a rising moving average. So that is one thing that I could notate that's a little different with the VIX compared to most times when I'm in these sessions, which has been recently just watching the VIX drift lower and lower and lower to multi-month lows. So if I were to right click, go to maximize chart, notice that moving average color did change over to green there with the VIX. That just happened here today. And again, what that signifies is price is now above a rising moving average. Now you can barely see that with the naked eye, but technically that is curling a little bit higher there. Now the last time that occurred, it was a head fake. So that's the other thing we got to be aware of. It did happen right over here as well at the end of March, and the VIX just wasn't happening. It gave up the ghost relatively easy within a couple of weeks there. So this is not necessarily go all in on the VIX type of a signal here, but just be aware of it. We have started to see a little bit of strengthening in the VIX, and that makes sense. Of course, the S&P 500 itself has been selling off the last couple of days, so it makes sense that the VIX has held up a little bit better in comparison. Other areas that have green charts, Treasury yields got a little bit of a boost here today. So remember, when interest rates go up, we typically find that the long bond goes down, and that's exactly the relationship that we found here today. As you can see down below here, TLT went a little bit lower. So yields are starting to firm up there a little bit. Remember, when that occurs, sometimes you get a little bit of extra benefit out of trading those financial stocks like banks and brokers to the upside. In fact, that was another one of my questions I received from you fellas and gals here today in my Q&A session was, how do brokerages like those various online brokers that you might use make money other than off of commissions? And one of the ways is through net interest margin and, being able to pay you a relatively small amount on your deposits and then reinvest your money at higher levels in treasuries or other income producing products. So right now, that boost in yields right there could help support those banks and those brokers if that were to continue. So we'll keep our eye on that trend. Now notice, MLPs really took it on the chin here today. This ticker symbol that we're looking at in the upper right-hand corner is AMLP, and that will track a basket of master limited partnerships. That is also an income-producing asset, but known as a bit more risky than your traditional bonds that might be out there because a lot of their fortunes are tied to the energy world. But nonetheless, you did see a quite dramatic drop of 1.7% there, and you can see how ugly that candle looks, and now we do have that moving average that changed from yellow to red here as a result. Now notice down below, crude oil really took a hit here today as well. And this is the first time we've seen some legitimate stress out of crude oil in quite some time. Remember, this has been one of the workhorses of the entire market in 2019, and now has finally closed below that 30-day moving average for the first time in over 3 months. There's been a couple of times where you touched it right there and right there, but you never closed below it. Today, we can officially say crude oil did close below that line, and we were having that conversation when I did this presentation on Tuesday about how energy stocks were lagging in comparison to crude oil prices, and I was saying something's got to give. Well, it's early, so we don't know this to be a fact yet, but what appears to be happening is what's giving is crude oil itself. It appears right now that perhaps the energy stocks themselves were correct in not going up dramatically, and maybe crude oil got ahead of itself from a price perspective, so it's going out and trying to find its equilibrium between buyers and sellers to try to identify where its appropriate price is. And right now, that does start to give you the fears of a little bit of a breakdown in the price action right there. And do note that the US dollar was up yet again, so second straight day to the upside for the US dollar. And remember, when the US dollar is strong, typically you find commodities struggle as a result. And so, gold spilled over here today a little bit, and so did crude oil. Let's go ahead and take a look at our next chart setup as well. And this one will be the foreign stock markets 12 grid. All right, so as this pulls up, you can see we're getting a lot more of these pink charts that are setting up. The only three that are bullish left on the board, at least bullish according to the market forecast technical indicator, is Germany, which I mentioned on Tuesday as being one of the more robust charts that were out there right now. We also have Japan, that's held up reasonably well. It might not have been quite as robust as what we're seeing out of Germany, but nonetheless, it does remain above that rising moving average. And then we also have South Africa, and that one's been a little bit more, kind of volatile type of a chart. So when you look at Germany and you look at Japan, those have been kind of consistent experiences to the upside. With South Africa, we've had this big move lower and then this big move higher. Now we've pulled back here recently, but it still hasn't pulled back enough to convert that back to a bearish posture. So that one would be a little bit more difficult to trade, at least if you're looking for trends. The other two might be useful to look at for trend trading purposes. But for the most part, these other charts are looking a little bit more bearish. I did have a viewer inform me that India perhaps is a little bit weak because they're going through some of their election season right now, and India was down yet again today, so that's the third straight day that India was down. And notice again that moving average is red up there, telling us that price is below a falling moving average, and of course that background color of the chart is telling us that the market forecast intermediate posture is bearish as well. So perhaps some bearish trading opportunities for India up there, and I could probably say the same thing for China. Notice that China is starting to break down as well. We once had this nice series of higher highs and higher lows with FXI up here, but recently we're breaking down, and if we were to go down another day or two, you could probably say that path has now been officially terminated, and we may now be on a path of lower highs and lower lows until we get another direction change. Again, we've got price below a falling moving average. Brazil doesn't look all that appetizing either. Brazil clearly in a path of least resistance to the downside. That downward trending moving average has really been in existence since March. These other ones have really just started here more recently. So this is a kind of a continuation move to the downside in those Brazilian securities. Russia had been kind of one of the more stalwarts, but unfortunately with crude oil prices falling here in the last week or so, like I mentioned a moment ago, that's kind of Russia's saving grace in a lot of cases. And so if crude oil is about ready to give up the ghost, then perhaps Russia is going to struggle as a result as well. All right, let's now take a look at the U.S. markets through chart 4G, and this is our U.S. markets 12 grid. All right, so as you can see here, things in the United States still are looking a little bit better than what we're seeing overseas. You do see a lot more green charts in this particular 12 grid. And the S&P 500 itself remains with that bullish posture as well. Of course, one thing to be aware of is we did get that overbought cluster signal about a week ago, so we're not entirely surprised to see a little bit of a weakness immediately following that. We got that cluster signal there on the financials, a little bit of a pullback. We got the cluster signal there on the communications, a little bit of a pullback. Cluster signal up there on technology, a little bit of a pullback. They're not dramatic pullbacks, so I don't want to make more out of it than it is. But nonetheless, those cluster signals were kind of giving us a little bit of a heads up that we'd gone a little bit too far too fast, and that we need to kind of slow down that pace of our upward trajectory in the market. So anyway, it'll be interesting to see where this takes us. But right now, the postures do remain bullish in most of the cases. Where we are starting to see a lot more stress is in the materials and energy space. Now remember, when I did this presentation on Tuesday, those two were already bearish at that point. All they've done since then is continue to fall. So, of course, it should not surprise us to see that they are still bearish at this point. In fact, things have gotten really ugly with energy in a hurry. Right? That's a pretty dramatic breakdown that we've seen there in XLE from, let's call it April 23rd to where we're at just here on May 2nd. That is actually, it is every single day. I was going to say it's about every day. It is every day. All of those candles are red. So we got 1, 2, 3, 4, 5, 6, 7, 8 straight down days for energy. That's pretty rough. You don't see that often. So anyway, that is not the place to be if you're looking for momentum-based trades. For those of you that are looking for more value opportunities, perhaps if things get flushed out to the downside enough, there might be some value opportunities that eventually emerge. Notice that down below here, XLV, this is healthcare in the lower left-hand corner. Now, this is one that I've been kind of patiently biding my time on. This is a chart that, as you can see, has been breaking down for a while. In fact, let me do this. I'm going to right-click, and I'm going to go to Maximize Sell. So this was a chart that, as most of you are aware, about a month ago, we really started to see major breakdowns. And we were talking about stocks like UNH and a lot of those other managed care companies within the healthcare space really taking it across the chin due to, some of the political rhetoric that was out there. And there's this fear that, eventually, there'll be a new regime in the White House and, a new Congress, et cetera, that will eventually start forcing the way that we did business in the past from a healthcare perspective to change dramatically enough where all of the companies that are hugely profitable in this modern era will no longer be as profitable in the future. Now, there's a lot of ifs that are involved in that. We don't know who will be elected, and we don't know what they will have the power to do. So right now, the market is trying to digest all of that information and try to right size the pricing of the merchandise, in this case, healthcare stocks in general. So we had this big breakdown in price action over here that took place. Now, it was so extreme that we eventually got an oversold cluster signal. And if you've been watching these videos recently, you'll know that, and we mentioned it multiple times, that was the only oversold cluster signal out of all of our sector charts for the last 3 months. So no other sector had an oversold cluster signal. Healthcare was the only one. And it happened because things really, really spiraled out of control quickly to get to that function where we then had all of those lines on the market forecast, the green, the red, and the blue, all in the lower reversal zone on the same day. So when that occurs, we generally assume that the pace of that move to get us into that condition will not continue. Now that can kind of manifest itself in a number of ways. Sometimes stocks will just go sideways after that, and that is stopping that move going down. Sometimes they'll continue to go down, but they'll just drift down. They won't continue to spike down like we saw right here. In a lot of other cases, we actually see a legitimate reversion to the mean type of a move. And that's exactly what we got out of healthcare here since putting in that cluster signal. So anybody who would have been brave enough to do something bullish on this day as a result of that signal, you just had yourself a really nice move. Now the problem is, this is not changing the trend of healthcare. notice that the moving average, in this case the 30-day moving average, can help us identify what trend is. In this case, we still have a bearish trend. Now the posture is bullish, and that's because that green line, after being in that lower reversal zone, has emerged out of it and has started to work its way higher. But you'll notice that that green line is nowhere near that upper reversal zone, so it's not nearly as strong as it was back in the heyday here about 3 months ago. So I'm not convinced that that green line is going to be able to continue going up at the pace that it has since we put in this cluster signal. I think that the move that it's just made out of those oversold conditions has exhausted itself to a degree. Now, I'm not saying it can't go up anymore. I'm just saying that this requires a lot of effort out of market participants to push prices up this hard, this fast. And when we had a already downtrending moving average that was in place prior to that, it leads me to believe that we're starting to lose a little bit of steam, and you can almost see it in the candles themselves. Some of these candles, like right here, right here, right here, those were very robust upside moves. Notice the last 4 days, we're starting to kind of round the corner, it seems like, where we're starting to approach that downward trending moving average, and market participants just aren't sure they want to actually fire up and through that particular line. And so what I thought we would do today is a bearish trade, a rare bearish trade, where we would assume that this major move off the bottom will not continue at this pace for the next couple of months. And if we're wrong, the particular trade that we're going to focus on is a defined risk trade, so we know how much we have at risk at any given time. So, because remember, you could go out and short this. Problem with shorting stocks is you have unlimited risk potential if the stock were to continue to go up. And remember, stocks don't have a ceiling technically. They do have a floor at 0, but stocks can go up forever. So when you're shorting them, you do carry a little bit more risk than you would with other types of strategies. So the strategy that we're going to use here today is known as a bear call spread. Some of you might refer to it as a credit spread or a sold vertical spread. There are different ways you can kind of phrase that, but you'll generally hear me refer to it as a bear call spread. And it is a credit spread. It is a way for us to kind of enact a bearish philosophy upon a chart where we make money off of time decay. And as long as we're not wildly wrong, we stand a pretty good chance of making money in the trade. Now, the downside of the trade is because it is a higher probability trade, we don't have spectacular upside potential in our reward possibilities either. So remember, you kind of have to balance that out with your own personality, whether you want higher probability of success, or are you going to go for the long shot where your success is not necessarily as high, but you have a chance of making a whole ton of money. So this is going to be one of those more modest reward possibilities here, but the probabilities of success will be a little bit stronger. So let me come on over here to the trade tab. I've already got the trade pulled up here ahead of time as I was prepping for this video. And you can see that what I'm doing is I'm going out to the June monthly contracts. Those are the ones with 50 days left until expiration. And you can see that what I've done is I've sold the 30 delta. Many of you tend to focus on the 30 delta as your sold strike when you're selling credit spreads. And that is what I'm doing in this case as well. That is the $92 strike. So you can see down below, I'm selling one contract of the $92 call for XLV that expires the month of June. Notice that I have a second part of that trade that says +1, and that one is going to be the 94 strike here on our strike chain. And the reason that we have a bought strike in addition to the sold strike is to do what I mentioned a moment ago, to define our risk. Remember, you could go out theoretically and just sell a naked call against this position, but you would be running into a lot of risk that if you were wrong with your analysis, you're going to have to pay the price if that stock, or in this case the ETF, were to continue to go higher. The reason that we would add a long call to this is if we are just flat out wrong and XLV goes from 89.48 where it closed today up to $100 in the next 50 days. Then we'd be flat out wrong, but because we own a long call at 94, our losses would be capped after that level. So this is known as a vertical spread, where we're constructing this with one sold strike and one bought strike. And the net effect of those two things is that we would receive a credit of about 50 cents right here. Now, as you guys have heard David and I talk about in the past, we tend to look for 30% return on risk when we're doing these types of credit spreads. So one thing that you can do is just click confirm and send once you've got it loaded up, and then these numbers right here will help you calculate your return on risk. So we're going to take our max profit of $50 and we're going to divide that by our max loss of $150, and you will see that that means that we have a 33% return on risk. That is a higher probability trade because as long as the stock doesn't go above 92.50, we would then be assumed to have made money on this trade. So remember, 92.50, where that number comes from, is basically taking your 50-cent credit and then adding it to your short call, in this case the 92. So 92 plus 50 is 92.50. On the chart, this isn't a great chart for this. Let me pull up a different chart. I'm going to pull up chart 4A here real quick, and then look at XLV. On the chart, 92.50 is right up here in this general vicinity. Now notice on this chart, 92.50 is at an area of resistance if you were to track your eyes to the left of my crosshairs. This is a security that has really struggled to get above 92.50 and stay above 92.50. So if you believe that will continue to be the case in the next 50 days, then this is a strategy that could potentially produce some profits for you. So we'll do it here as our paper money example from an application perspective. I'm going to click confirm and send again and then ship that off. All right, well, I want to thank you for joining me here tonight. Again, interesting day in the market. Markets were down, but we did have that spectacular IPO success with Beyond Meat. So, market participants haven't just taken their ball and gone home. They're still looking for opportunities that are out there. So I will not be with you here in the next couple of days as I'll be back in Omaha. But again, follow me on Twitter at Brandon Vanzi if you want to get my insight about the things I'm learning and seeing in Omaha. But David will take good care of you in the next couple of days on these videos. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.